Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, September 24th, 2020. It's been a wild one already today, and we're not even close to halfway done yet. Because when I tape, although you're seeing this probably at midday, we're taping this a bit before midday. So let's say in the first hour and a half, we've seen some wild swings in the major indices. And now we're actually more or less unchanged, depending on your index. But we've had essentially a 2% range just in intraday morning trading. By the way, quick note about volatility. A lot of time, historical volatility is typically measured close to close. That's actually really not useful if you're trading. The real volatility, and this is something we used when I was actively making markets, was the concept of high-low volatility. It's much more relevant to see if a market closes unchanged on the day. Volatility is essentially zero if you're doing close to close. In the meantime, the market could have been up 1%, down 1%. So what's really the historical volatility? What's the right volatility? Well, the volatility is 2% actually, and you really should be trading off of that. And if you're actively trading, particularly those of us who hedge gamma in an automated manner, you've had plenty of opportunity to buy low, sell high, and get your gamma paid for, as long as you paid less than a 32 vol, which is equivalent to 2% a day. So if you bought that volatility at a 16 and you saw it move 2% intraday, you had a nice win on that one. So don't lose sight of the fact that a market can close unchanged. And those of you who look at line charts, you might want to start looking at bars and candles. That has a lot to do with volatility. And volatility is what's going to lead me into the next part of our discussion. And that is margins. And I am not going to address the activities that our firm undertook regarding margin rates. It's not my role to comment on that. But let me give you something to think about a bit more broadly when it comes to trading on margin. Leverage, which is what margin is doing for you, you're adding leverage to your trading. Trading, once you add leverage to any sort of financial equation, you amplify the risk reward of any particular transaction. Most of us buy our house. This is not to say that leverage should always be avoided. I own my house with some leverage. I've lived here for 20 years, so it's not particularly levered at this point. But, people buy cars with leverage. Businesses operate with leverage. And to a certain extent, that's healthy. If you can cover your mortgage payments in an easy manner, well, then it behooves you to borrow the money to buy the house. If you need a car to get to work and can't afford it otherwise, and that car will allow you to help you get to your job, well, then it does pay to borrow money to own that car. Businesses, they need working capital. They don't necessarily have it. Assuming it's a productive enterprise, they need to add leverage to it. As an investor, do you need to add leverage to your day-to-day trading? And that is something you really have to consider. Because what happens is, when you pay cash for something, effectively, all you can do is lose your investment. You don't find yourself in a situation where you owe more money than you put in. If you borrow money, you have to pay that money back. It's an asset. You have an asset instead of just having an asset. You have an asset and a liability. And of course, the difference there is your residual equity. If there's no leverage, you have an asset and equity. And the value of that changes. And when I say equity, I'm not talking about equities in terms of equity markets. I'm talking about the accounting concept of asset liability equity. But so if you pay cash for it, you have an asset, and that asset has a value. And that value is the equity. And at some point, if you sell that asset for more than you paid, you made a profit. If you sell it for less, you lost your money. In the case when you add a liability into it, well, the equity is the asset minus the liability. And so if the asset appreciates, you basically, your equity appreciates faster than it would otherwise if you didn't have the leverage. Unfortunately, if it declines, it depreciates faster than if you had the leverage, than if you didn't have the leverage. So if you bought something for 100, if you pay 100 for it and then you sell it for 110, you made $10. So you're made 10%. Consequently, if you sell it for 90, you lose 10%. That's your P&L. If you bought it with 50% down, so if you paid 100 for something but borrowed 50 of it, if it goes to 110, you sold it for 110, you pay back your $50,000, your equity is now $60,000. That's 10. So basically, $10,000 gain on 50% equity is a 20% increase. Consequently, if you sell it for 90 and you still owe the 50, well, then that's a 20% loss. So you've magnified your profit and loss. The loan still has to get paid back. And so if you're magnifying your profits and losses in an environment that is highly volatile, it really behooves you to consider the risk that's underlying in the marketplace. And as things get more turbulent, as we see an election that is becoming increasingly more uncertain with an outcome that is increasingly more up in the air, and as I alluded to, as I wrote in a piece last week about how risks are increasing, how the market's perception of risks are increasing, how the VIX is telling you that it sees greater risk not only into the election but afterwards, it's telling you that there's either some sort of electoral uncertainty or that there's some sort of blue wave coming, in which case we have a president and a Senate and a Congress who've more or less committed to rolling back some of the capital gains decreases that we've seen, the corporate tax decreases. Neither of those outcomes is particularly market friendly. And then just this morning, throwing the whole concept of a contested election into the mix doesn't make people any less spooked about risk. So the point of this is not to discuss any changes that Interactive Brokers has made with its margin, but you need to be thinking as well about why you're using margin, how you're using margin, and the risks of using margin. Do you want to be adding risk to a portfolio as the market is doing that for you? We'll see. But please consider this stuff carefully when you make these kind of decisions. Have a good day, everybody.